Finding a discounted stock in technology is rather difficult in 2024. The AI craze has made a lot of stocks really fly up, especially in semiconductors. And other software companies and data center companies are really going up in value. I think a lot of it is hype, some of it is real, and it's tough to determine how much hype is out there. I may have found a diamond in the rough in Hewlett Packard Enterprise. This is a long-time technology company. And this part of Hewlett Packard, or I should say, this company is a spinoff from Hewlett Packard that really focuses on the enterprise, meaning they develop technology products and sell them to businesses, as opposed to their counterpart sells to consumers. This company is in a space that is going to assist in AI for particular workloads. And they are getting somewhat of a tailwind now as investors realize that they are an AI play. Not a big one, not a leading one, but they are going to benefit from the AI buildup. I wanted to go through and analyze Hewlett Packard, tell you what I think the company is worth, and tell you what I'm planning to do with this stock. Am I going to be buying shares or not buying shares of Hewlett Packard? I'll take you through my process, which is pretty consistent, and then make that decision with you. Do me a favor and like my video and subscribe to my channel. I'd appreciate that. Now let's take a closer look at Hewlett Packard. Should I buy shares in Hewlett Packard Enterprise? Well, the first question I have is, do I really believe in the company? Do I want to be a part owner in Hewlett Packard Enterprise? Do I think the business is profitable? Will they be growing in the future? Do I think their industry is good, a good industry to be in for the long term? And is the company operated well? Is the management team doing the right things? Those are questions that I need to answer before I make a decision to buy. The other area that I'm going to look at is the balance sheet. If they have too much debt, I will pass on the stock, but I need to know that debt is less than 3 times EBITDA. And I need a discount on the stock. I want to buy a stock and I want to see that the value of the stock price go up over time. And in this case here, Hewlett Packard also pays a nice dividend, which is good. And based on what I find, I will buy Hewlett Packard stock or sell the shares that I already have. Hewlett Packard provides a lot of data center technologies in the form of high performance servers, networking, software that really powers big workloads, big applications, big things on that businesses need to run. And they have been a successful company for many years. About 30 years ago, they were one of the premium technology companies. Probably up until probably about 20 years ago, they were just recognized as one of the leading companies, period. But really, the competition in hardware has been really, really tough over the last 15 years. And everything's moved from an on premises situation where a company buys their own servers, runs their own servers in their data center, to really moving everything to the cloud, meaning rather than buying hardware and so forth, a business might instead subscribe and buy the capacity, the compute, and put their workloads in a data center that's completely outsourced. Hewlett Packard's currently changing their strategy and really aiming to adapt to the new way that businesses want to consume their technology, which is really good to see. And that if they adapt well and grow in the new way of doing business, they're going to be really successful. If they fail in that strategy, they're probably going to fail and they probably will go away at some point. It's good to see the management team is resetting the strategy. And based on their latest earnings call that happened just last week, they are seeing progress on that strategy. They're seeing that their uh, SaaS business and their PaaS business and IaaS business is doing better. They're growing 41% if you look at their subscription rate or their subscription revenues. That's really good. It's good to see that. Meanwhile, they are losing revenues from their legacy business, the way they used to sell big servers and then recognize that revenue all up front. I think that's going to be potentially a temporary situation. And once they have, comparable years where they've moved to a more subscription-based business, they'll probably see some good growth. We'll see. I think it's a diamond in the rough. It needs time for the management team to execute on that strategy. And if the strategy is successful, I think there's a good payoff for Hewlett Packard. Looking at some of the fundamentals of Hewlett Packard, there's a reason why I really looked at this stock. Right now, technology stocks are really expensive, but you could see over the last 12 months that Hewlett Packard stock has been going down. Yet the company is paying a dividend of 3.3%. And I wanted to see if the fundamentals really show that the company is undervalued in a good investment. To begin with, the stock is flat in 1 year, but it has been going down recently. The market cap is only $20 billion, which makes them a small cap. The revenue is $28 billion. So you could buy the company at less than 1 times revenue, which is pretty incredible. They are profitable and they have a really low PE of less than 12. If they begin to grow, that PE is going to change. A growing company deserves more than a 12 PE. So we'll see if they start to grow. Analysts are holding on the stock. A few analysts do evaluate this company and they have a hold on the stock. The company announced their earnings, and although their revenue dropped from quarter to quarter, or I should say, for the quarter they closed compared to the previous year, they did drop revenue, but they grew the business in the right areas, which is why the stock actually rallied after it initially dropped. It rallied and it really gained more than 2% on the day that it announced their earnings. Now I'm going to value Hewlett Packard Enterprise, and I'm going to use two methods. The first, I'm going to discount the free cash flows I expect the company is going to produce in the future. Second, I'm going to look at the earnings per share and value the company based on earnings per share. Let's work with free cash flow first. Just a couple historical numbers. If we look at free cash flows for the last 5 years, free cash flows have actually grown 9%, which is good to see. The revenues have been flat overall, but again, they've moved from a legacy business to a new cloud business. So they're moving revenue from one part of the business to another. So overall, it's a positive, but they haven't seen any top line growth. For the first 4 years, I'm going to grow free cash flows by 6%. And then long term, I'm going to grow cash flows by 3%. Those are growth rates in my cash flows, and I'm going to discount those free cash flows by 9%. And based on those expected free cash flows into the future, which start at 1.9 billion, which is what the company's guided. They've guided that, hey, we're going to have at least $1.9 billion of free cash flow. I'll grow those free cash flows in the first 4 years by 6%, and then terminal value will grow by 3%. Discounting all those free cash flows by 9%, I get 31.9 billion. I'm going to add the cash and take away debt to get to an equity value of 27.8 billion. But the company market cap is only 20 billion. So in essence, the company is discounted by 58% if you look at free cash flows, which is really interesting. And the company pays a nice dividend of 3.3%. Now let's look at earnings per share. So earnings per share for this year is expected to be $1.96, and they have a really low PE. I'm going to use a PE of 12, expecting that they're going to have some modest growth, and they are growing in the right area of the company. So 12% PE, and it could be much higher, especially if they start growing in that really desirable subscription business. I'm going to grow at 5%, expecting that they are going to grow. And based on those factors and the formula that I've had here to value company based on earnings per share, I get a value per share of $20.10, which is higher than their current stock price of $15.57, showing that it's actually the company's stock is discounted by 29%. So overall, there's a 48% blended discount on the stock. I put more weight in free cash flows. I put 2/3 weight on free cash flows, 1/3 on earnings per share, because I believe free cash flows is a better measure of a company and their value. But it is a nicely discounted stock. And again, they pay a nice dividend. Hewlett Packard Enterprise is potentially a diamond in the rough that's going to be valued a lot more. But I still have to make sure that I really believe in the business. First, do I think they're doing the right things around strategy? And do I think it's a good business to own? Do I think their cloud strategy is going to work? And I do believe in that. I think their management team is doing the right thing, and customers are buying into the subscription business that they're selling. So those things are good. This industry tends to be cyclical. And right now we are on a growth trend with AI. Now, other business spending on technology hasn't been doing great, especially around, PC sales and things of that type. But I think that's going to begin to pick up. The economy has been doing okay, hasn't been setting any records from a GDP growth, but we've been doing okay, and profitability is out there. Companies are reporting good profits. So I think businesses are going to continue to invest in technology because technology enables those businesses to become more efficient, be more competitive, and really fit to the modern ways that their customers are expecting to do business with them. The balance sheet for HPE is in really good shape. It's well below 2 times EBITDA, and that's well below my metric that they need to be at 3 times EBITDA. And they offer a really attractive discount. So I'm going to buy shares of Hewlett Packard Enterprise. And I like the stock because they pay a nice dividend of 3.3%. And I feel like I'm buying into a stock that's really nicely discounted. I think there's really good upside, especially if their cloud strategy, their subscription strategy really works. This stock could double over the next 5 years. No matter what the market conditions are, you could always find a company that's discounted. And I may have found one here in Hewlett Packard Enterprise. I calculate that they are nicely discounted and they pay a nice dividend too. So I'm going to be buying shares of this company. Now, if their strategy works and they move a lot of their top line revenue to a subscription and they continue to move their technology to the cloud, I think they're going to get a different valuation and their PE is really going to go up. That would then cause this stock to really go up in value. And I think there's a good chance of the stock doubling over the next 5 years. We'll see what happens. I'm going to be looking at the stock every quarter and seeing how their strategy plays out. Thanks for watching the video. I really appreciate it. Do me a favor and like my video and subscribe to my channel. Good luck investing in 2024.